What if I told you that Ethiopia's latest $3.4 billion loan from the IMF is more than just a friendly gesture to help Ethiopia's development? From currency devaluation to crushing inflation, the strings attached to this money are choking not just Ethiopia, but the whole African continent. If you think colonization is a dark chapter of the past, watch till the end to understand how powerful Western institutions are preventing African economies from thriving. My name is Marvin, and I've been living in Nairobi, Kenya for the past year and a half. I've been closely following the continent's developments and the significant changes happening across Africa. But now let us dive into the topic and start with what the IMF actually is. The International Monetary Fund, also called the IMF, was founded in 1944 to promote global financial stability and prevent economic disasters. Funded by contributions from its 190 member countries, with the US and other wealthy nations contributing the most. So basically, it's an institution by Western powers for Western powers. The IMF claims to help countries, including those in Africa, by providing loans. However, these loans often come with conditions, like cutting public spending and opening up markets to foreign investors, which critics argue mainly benefits Western countries like the US, for instance. While the IMF says it's helping Africa to grow, in practice, its policies often deepen debt and keep African nations dependent on foreign powers. So why did Ethiopia need an immediate loan? Ethiopia's immediate need for the new IMF loan stems from its bad financial situation. The government is under pressure with a massive debt burden, much of which is mainly in foreign currencies like the US dollar. These debts were accumulated over years of borrowing from international institutions, including previous IMF loans and World Bank funding. The economic impacts of the several armed conflicts, droughts, and global economic conditions have depleted Ethiopia's foreign currency reserve. The country's official foreign exchange reserves have dropped significantly, making it harder to meet external obligations such as debt servicing and import. In December last year, Ethiopia already failed to pay back $33 million on its only international government bond. Without proper reserves, Ethiopia further risks defaulting on its existing loans, which would damage Ethiopia's credit ratings and increase borrowing costs. To prevent this, Ethiopia needs a new IMF loan, mainly to service previous loans, and that is a sign that the country is trapped in a cycle of debt dependency. The new loan is meant to help Ethiopia pay off its existing debts and rebuild its reserves. But that raises the question, is Ethiopia borrowing just to pay off old debts, perpetuating a never-ending cycle? So let's move over to how Ethiopia was forced into another IMF loan. The IMF often presents itself as a lifeline to countries in financial distress, but its loans come with very tight conditions. In Ethiopia's case, a key requirement for securing the new loan was to address the country's long-standing black market for foreign currency, which had been undermining the formal exchange rate system. For years, Ethiopia had a thriving black market where foreign currency could be exchanged at rates twice as high than the official rate set by the government. This discrepancy arose due to the country's strict currency controls, which limited the availability of hard currency in the formal market and the fact that Ethiopia is importing more than exporting. Therefore, there is a lack of dollars in Ethiopia's economy. Importers and travelers, unable to obtain enough dollars or euros at the official rate, turned to the black market for their needs. The IMF saw the black market as a destabilizing force that distorted economic policies and created opportunities for corruption. One of the conditions for Ethiopia's new loan was to kill the black market, bringing the official rate closer to the black market rate. Devaluing the currency makes Ethiopia's exports cheaper and more competitive on the global market. However, it also leads to a higher inflation because essential goods like fuel, food, and machinery become more expensive when purchased in foreign currency. Ethiopia, which relies heavily on imports, has experienced persistent high inflation as a result. By weakening the birr, the IMF aims to encourage more exports and reduce the trade deficit that comes at the expense of ordinary Ethiopians who now face rising cost of living. A consequence of that is that the already cheaply sold goods become cheaper and the margins for producers are getting much smaller. And the black market for currency exchange has existed for decades, fueled by Ethiopia's shortage of foreign exchange reserves and government restrictions on access to hard currency. So now by forcing Ethiopia to align the official rate with the black market rates, the IMF profits not only from interest on the loan, but also by pushing the country to adopt policies that suit international investors who benefit from cheaper exports and more transparent exchange rates. So Ethiopia's high inflation is nothing new. But there was a time when Ethiopia had a double-digit economic growth for 11 years straight and was one of Africa's fastest growing economies. Things have changed, and over the past decade, inflation rates have consistently been elevated, driven by a combination of factors. For instance, the currency devaluation. As mentioned, the IMF's condition to devalue the birr has directly contributed to inflation. By making imports more expensive, everything from fuel to basic foodstuff has risen in price. Another reason for that is the several armed conflicts, which disrupt agriculture production and supply chains, and this has led to increased food prices. And also the global inflation pressure, particularly in energy and food, have exaggerated domestic price increases, pushing inflation higher over the years. All of those factors lead to a weaker economy and to the need of taking more loans from foreign institutions. So now let us have a look at how the IMF profits from Ethiopia's currency devaluation. While the IMF's official mission is to help stabilize economies, it also stands to benefit from the policies it enforces. By devaluing Ethiopia's currency and opening up the economy to global competition, the IMF claims to facilitate foreign investment. Countries like Ethiopia, which primarily export agricultural products, find their products more attractive to international buyers because they are even cheaper after the devaluation. However, the downside for Ethiopia is that the devaluation makes debt repayment even more expensive. Most of Ethiopia's external debt is in US dollars. So as the birr loses value, the cost of repaying these loans increases. This creates a debt spiral where Ethiopia has to borrow even more money to service its existing debt, locking the country deeper into the IMF's dependency. Additionally, the IMF benefits as it gains leverage over Ethiopia's economic policies. By tying financial aid to certain conditions, the IMF can shape economic reform, pushing Ethiopia towards opening the market to foreign capital and privatization, a move that tends to favor international investors more than domestic growth. Ethiopia isn't the only African nation entangled in the cycle of IMF loans and the devastating effect of structural adjustment programs. Other nations such as Mali, Kenya and Ghana have endured similar challenges, often leaving them economically weakened while enriching external powers. Let's have a look at Mali, a case of economic collapse after IMF intervention. In the 1980s and the 1990s, Mali, one of the world's poorest countries, was forced to adopt IMF-led structural adjustment programs to secure vital loans. The SAPs imposed on Mali required sweeping changes to the economy, including privatization of state-owned enterprises, drastic cuts in public spending, and the devaluation of the national currency. While these reforms were aimed at stabilizing the economy, they came with dire social and economic consequences. The privatization of state assets, such as mining and cotton industries, benefited foreign investors but led to the exploitation of Mali's natural resources. Local workers saw very little benefit, with wages falling as foreign corporations extracted wealth from the country. The cuts to public sector spending also slashed vital services. Education and healthcare was underfunded, causing a decline in literacy rates and an increase in preventable disease. Additionally, subsidies for essential items like food and fuel were eliminated, causing a widespread poverty and social unrest. Mali's economic restructuring deepened its reliance on foreign aid and loans, creating a cycle of debt. Despite decades of strict measures, the country remained in poverty, with little substantial economic growth. The IMF's policies failed to address the structural problems in Mali's economy, leaving the nation worse off than before the intervention. Then let's have a look at Kenya. Kenya's long-standing relationship with the IMF has similarly been marred by heavy conditions and structural adjustment. After the country was granted a $2.34 billion loan in 2021 to stabilize its economy in the wake of COVID-19, it was required to implement a series of painful measurements. These included the devaluation of the Kenyan shilling, tax increases, and cuts to public sector wages. The currency devaluation made imports more expensive, leading to a rise in the cost of living. Meanwhile, higher taxes on goods and services disproportionately affected the middle and lower class, while public workers faced reduced income. In addition to these immediate effects, Kenya's public debt has ballooned. As of 2023, Kenya's total public debt stood at $70 billion, with a significant portion owed to international financial institutions like the IMF. This mounting debt is a ticking time bomb, with an increasing share of national revenue being diverted to servicing loans rather than funding development projects. The conditions tied to the IMF loans have hurt Kenya's economic growth and placed tremendous strain on ordinary Kenyans. The short-term financial relief offered by these loans has often come at the expense of long-term economic stability. Let me just give you one last example. Let's have a look at Ghana. Africa's largest IMF debtor, Ghana is another African nation caught in the IMF's debt trap, currently holding the highest IMF debt on the continent. By 2023, Ghana owed over $3 billion to the IMF, and its economic situation reflects a similar pattern of structural adjustment inducted. In the early 1980s, Ghana was forced into adopting the IMF's SAPs, which required currency devaluation, opening up the country for trade, cutting government spending, and privatizing state-owned enterprises. While these measures were intended to reduce the country's deficit and stabilize its economy, they ended up dismantling vital social services. The privatization of industries meant that foreign investors took over Ghana's key economy sectors, while local businesses struggled to compete. The cuts in government spending led to mass layoffs, leaving many Ghanaians unemployed. Education and healthcare budgets were slashed, leading to a decline in access to these critical services. By 2022, Ghana's economic crisis deepened, mainly led by inflation, a depreciating currency, and high external debt. The IMF loans were seen as the only solution to meet the growing financial challenges, but this simply added to the country's debt burden. As Ghana continues to negotiate new terms with the IMF, it is clear that the SAPs have entrenched the nation in a cycle of debt dependency. So I was talking about the IMF structural adjustment programs, but how do they actually work? and why were they implemented? The Structural Adjustment Programs, also called the SAPs, introduced by the International Monetary Fund and the World Bank in the 1980s, are a set of economic policies that countries must implement as conditions for receiving loans. These programs are often applied to nations facing economic crisis or unable to pay off existing debts. But where do these debts come from? So Africa's debt can be traced back to colonial times, when European powers borrowed money to establish the infrastructure to exploit the continent's resources. After gaining independence, the colonizers left behind fragile economies and debts that the newly independent African nations took over and were pressured to pay back, and they didn't even take these loans themselves. So these loans, combined with unfair trade practices and global economic pressure, led to massive debt accumulation. This is just one example of Thomas Sankara speaking about the immorality of this debt trap and suggesting to other African leaders during his speech at the AU not to pay back the debt. And it's not hard to imagine what happens to these kind of African leaders. So the SAPs usually resolve around three core policies. The first one is currency devaluation. This means reducing the value of a country's currency compared to foreign currencies. The goal is to make a country's export cheaper and more competitive on the global market. This should boost the revenue from trade. However, the downside is that imports become more expensive. Since many developing countries rely on importing essential goods like food, fuel, and medicine, this often leads to inflation, where the cost of living rises rapidly. Let me give you one example for this. In the 1980s, Zambia was forced to devalue its currency to meet the IMF's requirements. While this made Zambia's copper exports cheaper, the country became vulnerable to rising import costs, especially for fuel and food, leading to widespread inflation and hardship for the population. The second thing they come with is privatization. So privatization refers to selling off state-owned enterprises, such as industries, utilities, and public services, to private companies. While this might inject immediate cash into a struggling economy, it often results in key sectors being controlled by foreign or private interests. These companies usually prioritize profits over the social needs, and locals may lose access to affordable services, especially in critical sectors like healthcare, energy, or transportation. Ghana was required to privatize its state-owned companies under its SAPs in the 1980s and 1990s. Essential services such as water and electricity were sold to foreign companies. While this attracted foreign investment, the local population faced higher costs for basic services, while little improvement in quality was seen. Let's get to the austerity measures. So austerity means cutting back on government spending, especially in areas like education, healthcare, and welfare. The idea is to reduce national debt and balance the budget. However, these cuts often hurt the most vulnerable citizens. Governments are forced to scale back or eliminate subsidies that make essential services and goods affordable, leaving the poor to suffer the brunt of the hardship. An example for this is Zambia also cut its social services budget dramatically under the IMF's guidance. This meant fewer resources for schools, hospitals, and infrastructure. Education rates plummeted, and healthcare services became too expensive for many Zambians, leading to problems in public health and increased inequality. Critics argue that the SAPs, while intended to stabilize economies, often benefit international creditors and investors more than the countries themselves. The consequences include, for instance, increased debt. So many countries find themselves taking on new loans to repay old debt, leading to a never-ending cycle of debt dependency. Another one is the rising poverty and inequality. Austerity measures and privatization often hurt the poorest citizens the most, while wealthier elites and foreign investors profit. And the loss of sovereignty. Countries are forced to implement policies dictated by the IMF, even when these policies are unpopular or harmful to their populations. This can undermine the democratic process and lead to political unrest. Another problem that comes with it is economic instability. So currency devaluations and rapid liberalization can destabilize economies, leading to inflation and market volatility. The IMF structural adjustment programs are a double-edged sword. While they may provide short-term financial relief, they often cause long-term harm by locking nations into cycles of debt and dependency, eroding local economies and widening social inequalities. So in conclusion, Ethiopia's experience with the IMF's $3.4 billion loan reflects a broader troubling trend across Africa, where international financial institutions exert overwhelming influence on domestic economic policy. While IMF loans are marketed as lifelines for struggling nations, they attach conditions like currency devaluation, austerity, and privatization often deepen economic challenges rather than alleviating them. Ethiopia, like other African nations, finds itself in a cycle of dependence, where borrowing is necessary to service existing debt, pushing the country further into financial instability. The inflation and economic strain caused by the IMF mandated policies disproportionately impact ordinary Ethiopians, as prices for essential goods rise, while wages and living standards stagnate. Meanwhile, international investors, lured by cheaper exports and privatized assets, benefit more than the local economy. Ethiopia's case serves as a cautionary tale, highlighting how African nations are often trapped by the very financial mechanism designed to assist them. This cycle of debt dependency and diminished sovereignty echoes across the continent, from Mali to Ghana. Until African nations can break free from these external economic shackles and find sustainable paths to grow, their development will remain complex compromised by the interests of foreign powers and financial institutions. The question that remains is, how long can this cycle continue before it's no longer Africa's debt, but Africa's future that is entirely mortgaged? Let me know your thoughts in the comments, and watch the videos edited here to get more updates on Africa's development.